Hello everyone and welcome back to the channel. Alright, let's kick things off with a bit of a shocker. Did you know that recent surveys suggest nearly 1 in 3 Aussies have never checked their credit score? Wild, huh? Especially when this little number plays a massive role in some of your biggest life moments. We are talking getting that first home loan, financing a new set of wheels, even sorting out a new phone plan. So, today we are diving deep into the world of Australian credit scores. What are they? Why should you give a toss? And most importantly, how can you make yours spark? So, stick around because by the end of this video, you'll be armed with the know how to take control of your credit health. No confusing jargon, just straight up advice for everyday Aussies like you and me. So, let's get into it. So, what exactly is a credit score? Your credit score is like your financial resume. It tells banks if you are a legend who pays bills on time or a bit of a loose unit. In Australia, three big dogs track your score: Equifax, Experian, and Alien. Think of them like the NRL of credit. Different leagues, same game. Now, you might be wondering why three different scores. Well, different lenders might use different bureaus, and each bureau might weigh factors slightly differently based on the info they have. The important thing is they all paint a picture of your credit worthiness based on your history. A higher score generally means you look like a safer bet to lenders. Simple as that. So, why does it matter? Okay, so it's a number, right? Big deal. Wrong. This number can be the difference between smooth sailing and hitting a brick wall when you need finance. For example, home loans. This is the big one for many first home buyers. Lenders scrutinize your score. A good score can mean getting approved, maybe even getting a better interest rate, saving you thousands over the life of the loan. A bad score, on the other hand, you might get knocked back or offered a higher, less favorable rate. Car finance. Same deal. One that new youth or family SUV, your credit score will influence your approval odds and the interest rate you pay. Same goes for credit cards and personal loans, rental applications, phone and utility plans, business loans. Basically, a good score opens doors and can save you money. A poor score can close them and cost you more. It really does pay to know where you stand. Section 3: Busting Common Credit Score Myths. Myth number 1: checking your own credit score lowers it. Busted. This is probably the biggest one. Checking your own score through official channels like the free credit score providers, which we will mention later, is what's called a soft inquiry. It does not impact your score. Hard inquiries happen when you actually apply for credit, like a loan or credit card, and lots of those in a short term can lower your score. But just checking, you're all good, mate. Check away. Myth number 2: closing old unused credit cards will boost my score. Busted. This sounds logical, but it can actually backfire for two reasons. Credit history length. Part of your score is based on how long you have had credit accounts open and manage them well. Closing an old card shortens your average credit history. Credit utilization ratio. This is how much credit you are using compared to your total available credit. Closing a card reduces your total available credit. If you carry balances on the other cards, this makes your utilization ratio jump up, which can look riskier to lenders. Keeping it open and ideally unused or paid off monthly can actually help. Myth number 3: having no credit history is the same as having good credit. Busted. If you have never borrowed money or had a credit card, lenders have no data on how you handle debt. You are an unknown territory. This isn't a bad like having defaults, but it can make it harder to get approved for significant credit, like a mortgage, because they can't assess your repayment behavior. Lenders need data. Section 4: daily habits that might be killing your score without you realizing. Let's talk about some everyday things that could be slowly chipping away at your precious credit score. Are you guilty of any of these? Missing bill payments, even small ones, especially since comprehensive credit reporting came into full swing around 2018-19. CCR means lenders don't just report the bad stuff like defaults, they also report your repayment history, including whether you paid your credit card or loan installments on time for the last 2 years. Even being a few days late consistently can flag you. Utility and telco bills can also lead to defaults if left unpaid long enough. So set up direct debits or reminders. Buy now, pay later. Services like Afterpay, Jeep, Klarna are convenient, right? But be careful. While timely payments aren't always positively reported, yet missed payments can be. Some BNPL providers do report defaults to credit bureaus if you fail to pay. Plus, lenders can see multiple BNPL accounts or frequent usage when they assess your bank statements during loan applications and might view it as a sign of poor budgeting or overcommitment. Keyword focus. Does Afterpay affect your credit score? Yes. Missing payments definitely can. Maxing out your credit cards. Using a high percentage of your available credit limit, known as high credit utilization, makes lenders nervous. It suggests you might be stressed financially. Try to keep your balance below 30 to 50% of your limit, even if you pay it off in full each month. Applying for too much credit too often. Remember those hard inquiries we talked about? Every time you formally apply for a loan, credit card, or sometimes even a phone plan, it leaves a footprint on your report. Applying for heaps in a short period looks desperate and can lower your score. Shop around, but only formally apply when you are serious. Section 5. Your comeback plan. Step by step guide to improve your score. Step 1. Know your score and report. You can't fix what you don't understand. Get your free credit reports and scores. In Australia, you are entitled to a free copy of your report from each bureau once every 3 months. Use free services like Credit Savvy powered by Experian or getcreditscore.com.au powered by Equifax to check your score regularly without hurting it. Also check out the government's moneysmart.gov.au website. Heaps of unbiased information there. Step 2. Check for errors and dispute them. Go through your reports carefully. See a debt you don't recognize, a late payment listed you know you paid on time, dispute it. How to dispute? Contact the credit bureau directly. Equifax, Experian, or Alien. Explain the error in writing. Email is good. And provide any evidence you have. For example, bank statements showing payment. They have to investigate. I'll leave a template email to dispute this in the description. Step 3. Pay everything on time. This is crucial, especially with CCR. Set up direct debits, calendar reminders, budget apps, whatever it takes. Consistent on time payments are the single biggest factor in building a good score over time. Step 4. Reduce your debts and credit utilization. Focus on paying down existing debts, especially high interest credit cards. Try to keep your credit card balances low relative to their limits, ideally under 30%. Don't just pay the minimum. Step 5. Be patient and strategic. The clean slate strategy. Improving your score takes time. Negative listings like defaults or court judgments don't vanish overnight. Defaults generally stay on your credit report for 5 years. Some telco utility defaults under CCR might drop off after 2 years paid. Bankruptcies stay longer. The good news, the impact of negative listings lessens over time, especially if you are building a positive recent history. Focus on steps 3 and 4 consistently. Remember, your credit score isn't set in stone. It's a dynamic number that reflects your financial habits. If you found this helpful, give us a thumbs up and subscribe so you don't miss our future videos. Take care of your credit health and I'll see you in the next video.